and welcome to the Property Wealth Podcast. Today, we're diving into an exciting topic that could really open some doors for you. We're talking about private REITs and how they provide access for accredited investors.
Yeah, it's a fascinating area of real estate investing. Private REITs can offer some unique benefits, especially for those looking to diversify their portfolios without the volatility of traditional stocks.
Exactly. And for our listeners, we'll cover what a private REIT is, how it differs from public ones, and why it might be a good fit for your investment strategy. If you're an accredited investor, of course.
Right, and we'll also discuss the potential risks involved, plus a few tips on how to navigate this space effectively. It's really about finding the right balance in your investment approach.
So whether you're looking to expand your knowledge or considering a new avenue for building wealth, this episode is packed with practical insights.
Absolutely. And we'll also share some real-life examples that can help make these concepts more relatable.
I love that. It's all about making this information accessible, especially for our listeners who are over 40 and might be thinking about long-term wealth building.
Yes! Let's get started, shall we?
Let's do it. So first off, what exactly is a private REIT, and how does it differ from the public ones we might be more familiar with?
You know, Sarah, when we talk about private REITs, it really hits home for a lot of folks over 40, especially when you think about retirement timelines.
Absolutely, Mike. I mean, many people in that age group are starting to really think about what their retirement looks like, right?
Exactly. And with the current economic climate, there's a lot of uncertainty. Inflation is one big factor that weighs heavily on everyone's mind.
Right. It can really eat away at savings. I read somewhere that even a small increase in inflation can have a significant impact on long-term wealth.
Yes, and that's where private REITs can come in as a hedge against inflation. They often adjust their rental rates based on inflation, which means they can potentially provide some protection for those cash flows.
That makes sense. So it's like they're not just sitting there stagnant, they're working to keep up with rising costs?
Exactly. And for someone approaching retirement, the idea of having a steady income stream is so crucial. I've seen investors, let's call him Dave, who had most of his savings in traditional stocks. When the market took a downturn, he felt that immediate impact.
Oh wow, that's scary.
Right? So Dave decided to diversify his portfolio by investing in a private REIT. He liked the idea of having a tangible asset backing his investment, plus the potential for regular distributions.
And how did that work out for him?
Well, after a year, he noticed that while his stocks were still volatile, the REIT provided consistent returns. It gave him peace of mind knowing he had something stable, something that even in a downturn wasn't going to disappear overnight.
I can imagine how reassuring that must have been for him. It's not just about the numbers. It's about feeling secure as you approach retirement.
Exactly, and that emotional side is often overlooked. The peace of mind that comes from knowing you have a plan in place can really affect your quality of life.
And speaking of quality of life, with wealth transfer becoming increasingly important, especially for those of us who want to leave something behind for our families, private REITs can be a great way to build that legacy.
For sure. I mean, take Lisa, for example. She started investing in a private REIT a few years back, intending to create a nest egg not just for her retirement, but also for her kids.
That's such a thoughtful approach.
Right? She wanted to ensure that her children would benefit from her hard work. By investing in a REIT, she's not only generating income for herself, but also increasing the value of her investment over time.
So it's like a win-win situation.
Exactly. And with the real estate market shifting, especially in the wake of the pandemic, there are new opportunities arising. Private REITs often focus on niche markets that can be less affected by those broader market swings.
Interesting. So it's not just about the big cities anymore, huh?
No, not at all. Many private REITs are looking at suburban developments, healthcare properties, and even industrial spaces. They're finding value in areas that traditional investors might overlook.
That's pretty smart. It opens up a whole new world of investment opportunities for people who want to get into real estate but might feel intimidated by the idea of owning property directly.
Exactly. And let's not forget, for those over 40, time is of the essence when it comes to building that wealth. The sooner you can start investing in something like a private REIT, the more you can potentially benefit from compound growth over time.
Right, and in a way, it's about making your money work for you, rather than just saving and hoping it grows enough to keep up with inflation, isn't it?
Yeah, that's spot on, Sarah. People often underestimate the power of passive income. It can really change the game, especially as you approach retirement.
And it's not just about surviving retirement, it's about thriving.
Absolutely. And let's not forget the tax benefits. Depending on the structure of the REIT, there can be advantages that help investors keep more of their returns.
That's a great point. And for someone like Dave or Lisa, that could mean the difference between a comfortable retirement and one filled with stress over finances.
Exactly. And with the current economic trends, the ability to pivot and adapt is more important than ever. The landscape is changing, and private REITs offer a way to be part of that change without needing to become a full-time real estate mogul.
Right. So what would you say is the first step for someone considering this option?
Well, the first step is really to educate yourself on the different types of private REITs out there and figure out what aligns with your investment goals.
That makes so much sense. You've got to know what you're getting into before you dive in, right?
Exactly. And also consider talking to a financial advisor who understands this space. They can help guide you based on your unique situation and goals.
It's all about building that knowledge base and feeling confident in your choices.
Definitely. And once you have that foundation, it's easier to take that leap into investing.
I think a lot of people would feel more comfortable knowing they're making informed decisions, rather than just jumping in without a plan.
Right. And that's the key to building long-term wealth through real estate.
Speaking of which, I'm excited to dive into some core strategies next.
So let's dive into some core strategies for investing in private REITs. The first thing that comes to mind is understanding your investment goals. Are you looking for cash flow, appreciation, or a mix of both?
Right, and that's really key. If you're mainly after cash flow, you might lean towards REITs that focus on income-producing assets, like commercial properties or multifamily units.
Exactly. And then there's the 1% rule, which is super helpful for evaluating properties. Basically, you should aim for a property that can rent for at least 1% of its purchase price each month.
So if you buy a property for $200,000, it should ideally rent for $2,000 a month, right?
Yep, that's it. But keep in mind, this is a guideline, not a strict rule. Different markets might have different benchmarks.
And then there's the 50% rule, which is another useful one. It suggests that you should estimate your operating expenses to be about 50% of your gross rental income.
Right. So if you're expecting to make $4,000 a month in rent, you should budget around $2,000 for expenses, things like maintenance, property management, and taxes.
It's a good way to keep your projections realistic. Now, when evaluating a deal, what's your go-to checklist?
Well, I always start with location. The old saying, location, location, location. Look for areas with strong job growth, good schools, and low crime rates.
And then you want to look at the property itself. What's the condition? Are there any major repairs needed?
Definitely. A property in good condition may have a higher upfront cost, but it can save you a lot in repairs down the line. And don't forget to check the rental history.
That's so important. Understanding what tenants are paying and how long they stay can give you a clearer picture of potential cash flow.
Exactly. And when it comes to financing, consider different options. Conventional loans, private money lenders, or even partnerships can all work, depending on your situation.
And if you're looking at private REITs, the financing might be a bit different too. You might find that some REITs offer unique financing structures that could be advantageous.
Right. And speaking of REITs, it's worth mentioning cap rates. This is a crucial concept for evaluating the potential return on investment.
Can you break that down a bit?
Sure. The cap rate is calculated by taking the net operating income of a property and dividing it by its purchase price. So if a property generates $50,000 a year in net income and you buy it for $500,000, the cap rate would be 10%.
That's a solid return. So you'd want to compare cap rates across properties and markets to see where you might get the best bang for your buck.
Exactly. Higher cap rates can indicate a potential bargain, but they can also signal higher risk. So it's important to weigh that carefully.
And then there's the need to diversify your investment, right?
Absolutely. Don't put all your eggs in one basket. Investing in different types of properties or markets can help mitigate risk.
Like, you could invest in a mix of commercial, residential, and industrial properties.
Right. And it can also mean looking at different geographical areas. Maybe one market is cooling down while another is heating up.
It's all about doing your homework and staying informed about market trends and economic indicators.
Yes, that's crucial. Keeping an eye on local developments, zoning changes, and infrastructure projects can really help you spot opportunities.
And have a solid exit strategy too. Whether you plan to hold the property long-term or flip it, knowing your exit strategy ahead of time can save you a lot of stress.
Couldn't agree more. It's all about having a plan. And don't forget to factor in your timeline. How soon do you need to see returns?
That's a big one. It can affect the types of properties you choose and your financing options.
And, when you're looking at private REITs, understanding the management team is also key.
Right. A strong management team can make a huge difference in the performance of the REIT.
Exactly. Check their track record, their experience in the market. Have they successfully managed similar properties before?
And what about fees? That's something to keep an eye on.
Yes. Management fees, acquisition fees, those can eat into your returns. Always read the fine print.
So with all these strategies and rules of thumb in mind, what are some common pitfalls to watch out for?
Well, one big pitfall is falling in love with the property. You can get emotionally invested, and that can cloud your judgment.
Oh yeah, that's so easy to do. It's important to stick to your criteria and analysis rather than getting swept up in the excitement.
Exactly. And also, not doing enough due diligence can be a huge mistake. Always dig into the numbers and understand what you're getting into.
It's like, the more you know, the better prepared you are.
Absolutely. And never underestimate the power of networking. Connecting with other investors can open doors and provide valuable insights.
That's so true. It's all about building a community around your investments.
Yes. And remember, real estate investing is a marathon, not a sprint. Patience and persistence are key.
Definitely. So, with that, let's transition into those common pitfalls a bit more.
So let's dive into some common pitfalls that we see, especially with private REITs. One of the biggest mistakes is over-leveraging.
Yeah, that's a huge one. I mean, it's tempting to think that you can just keep borrowing more to increase your returns, right? But if things go south, that can really hurt.
Exactly. I remember a client of mine, let's call him John. He was really ambitious and thought he could manage multiple properties by leveraging heavily. He ended up in a situation where, when the market dipped, his returns plummeted and he was stuck with high debt payments.
Ouch, that sounds stressful. Did he have any contingency plans?
Unfortunately, no. He'd focused solely on the potential upside and didn't prepare for any downturns. It's like building a house without a solid foundation. You can't just assume prices will keep rising forever.
Right, and that leads us to another pitfall. Bad tenants.
Oh, absolutely. Finding the wrong tenants can derail your investment, can't it? I had another client, let's call her Lisa, who didn't do proper tenant screening. She ended up with tenants who were consistently late on rent and eventually stopped paying altogether.
That sounds like a nightmare. What happened next?
Well, Lisa had to go through the eviction process, which is not only costly but also time-consuming. She lost several months of rent and spent even more on legal fees. If she had just taken the time to vet her tenants properly, she could have avoided all that hassle.
It really emphasizes the importance of tenant screening. I assume asking for references and checking credit scores is a must?
Exactly. And also understanding their rental history. You want to look for red flags during the application process. If someone has a history of evictions, that should definitely raise a warning sign.
And then there's ignoring cash flow, right?
Yes. Cash flow is the lifeblood of any real estate investment. I worked with a couple who bought a property thinking it would appreciate quickly, but they didn't calculate the monthly expenses properly. They ended up with negative cash flow and struggled to keep up with maintenance costs.
That's heartbreaking. So they were basically losing money every month?
Exactly. They thought the property value would make up for it, but in reality, they were sinking deeper into debt. If they had focused on cash flow from the start, they could have made smarter decisions.
It sounds like a good rule of thumb is to always have a clear understanding of your expenses before diving in.
Definitely. And then there's the issue of timing the market, which can be a real trap.
Ah, yes. The classic, I'll wait for the right moment mindset.
Right! I had this investor named David who spent years waiting for the perfect time to invest. He kept thinking prices would drop, but in the meantime, he missed out on multiple great opportunities. By the time he finally bought, prices had skyrocketed.
That's so frustrating. So he lost out on potential gains because he was waiting for a dip that never came.
Exactly, and it's an emotional roller coaster, right? Real estate investing shouldn't be about trying to time the market. It's more about making informed decisions based on your financial situation and goals.
And then there are hidden costs, which can sneak up on you.
Oh, for sure. I had a client, let's call her Emily, who bought a property thinking the numbers looked great on paper, but she didn't account for things like property management fees, maintenance costs, or even property taxes that weren't disclosed up front.
Those hidden costs can add up quickly. Did she end up regretting the purchase?
Unfortunately, yes. She realized that her profit margins were razor thin. If she had done more thorough due diligence, she might have reconsidered or negotiated better terms.
So what's the takeaway here? How can someone avoid these pitfalls?
Well, it really comes down to education and preparation. Make sure you understand your numbers inside and out. Evaluate your cash flow, do proper tenant screening, and don't rush into decisions based on market timing.
And always keep an eye out for hidden costs. It's all about being proactive rather than reactive, right?
Absolutely. And if you do find yourself in a tough spot, it's important to assess the situation calmly. Sometimes that means reaching out to professionals who can help guide you through the next steps.
That's great advice. So it's really about learning from these experiences and using them to make better decisions moving forward.
Exactly. Mistakes can be valuable teachers if we let them be. Just remember, it's a journey, and every investor faces challenges at some point.
Well, I think that's a perfect segue into our next topic. What are some practical strategies for moving forward after facing these challenges?
So, now that we've unpacked private REITs and what they can offer, let's dive into some immediate steps our listeners can take, right?
Absolutely. The first thing I'd recommend is to assess your current financial situation. Just take a moment to, sit down and figure out what you're comfortable investing. Maybe create a budget for how much you can allocate towards real estate.
Yeah, that's a great start. It's all about knowing your numbers. And once you have that figured out, you can start researching private REITs that fit your investment criteria. A simple way to start is by checking out platforms like Zillow. They can give you a sense of property values in different markets.
Right. And, Bigger Pockets is another fantastic resource. They have forums where you can connect with other investors and get insights about private REITs. It's like having a community right at your fingertips.
Exactly. Plus, they offer calculators that can help you analyze potential investments. You can enter different variables and see how they affect your returns, which is super useful.
Oh, I love calculators. They make everything feel more tangible. And if you're looking at rental properties, tools like Rentometer can help you gauge rental prices in a specific area. It's a great way to ensure you're not overpaying for your investment.
For sure. And if you're more serious about diving in, consider getting access to your local MLS. It gives you a comprehensive view of properties, including those not listed on public sites.
Yeah, that insider information can really give you an edge. And while you're at it, think about setting a small habit, like analyzing just one deal per week. That way, you're consistently learning and keeping your skills sharp.
That's a good point. It's all about consistency. Joining a local real estate meetup can also be beneficial. You'd meet other investors, share experiences, and maybe even find mentors.
That networking aspect is so valuable. And don't forget about books and podcasts, right? There are some incredible resources out there.
Absolutely. A few that come to mind are the book on rental property investing by Brandon Turner, and of course, the Bigger Pockets podcast. They're packed with real-life stories and practical advice.
Those are solid recommendations. I also think the Real Estate Guys radio show offers a lot of insights into different investment strategies, including REITs.
Definitely. And it's important to keep your mind open. Maybe set a goal to listen to one real estate podcast a week. It can really help broaden your perspective.
And you can do that while you're, cooking or exercising. It doesn't have to take extra time out of your day.
Exactly. Just fit it into your routine. Also, consider keeping a journal of what you learn. It'll help you reflect and track your progress over time.
That's a great idea. Sometimes writing things down can really solidify your understanding. And as you grow more confident, maybe start exploring specific private REITs to invest in.
Right, and when you're ready to take that leap, make sure you thoroughly research the REITs you're considering. Look into things like their track record, management team, and the types of properties they invest in.
Oh, and don't hesitate to ask questions. If you're speaking to a potential REIT or their representatives, make sure you're clear about fees, performance history, and any other concerns you might have.
Well said. It's about being informed and comfortable with your choices. And remember, starting small is perfectly okay. You don't have to dive in with a huge investment right away.
Yeah, start where you are. Each small step you take builds your knowledge and confidence.
So those are some practical first steps. Now let's bring this all together. Well, Sarah, I think we really unpacked a lot about private REITs today.
Absolutely, Mike. One of the major takeaways is that private REITs can be a great way for accredited investors to access real estate markets without the typical barriers.
Right, and we discussed how they often provide higher returns compared to traditional public REITs. But of course, they come with their own set of risks too.
Exactly. And another key point was the importance of doing your due diligence. Really understanding the fund's management and the assets they hold.
Yep, and let's not forget about the liquidity aspect. While they can offer great investment opportunities, it's important to know that you might not be able to cash out as easily as with publicly traded options.
So true. And, for many listeners, the idea of diversifying their portfolios with real estate can feel daunting, but it's all about taking that first step.
Yeah, and real estate is such a powerful tool for building long-term wealth, especially for those of us over 40. It's never too late to start.
Absolutely. So if you found value in today's conversation, we'd love for you to like, subscribe, and comment on your biggest takeaway or any questions you might have.
And if you know someone over 40 who's looking to dive into property investment, share this episode with them.
Next time, we'll dive into master lease options. That's all about control without ownership, which is super exciting.
It really is. Thank you all for tuning in today. We appreciate you being part of our community.
Take care, everyone, and we'll see you next time.